Hey, my name is Tom Steele, and this presentation is on accounting principles, in particular, the matching principle. So let's start off with what exactly accounting principles are. When accounting for their economic activities, public companies must follow generally accepted accounting principles, also referred to as GAAP. These principles are the accounting standards, rules, and procedures that make up the guidelines for conducting financial accounting. In Australia, these rules have been developed over time by the Australian Accounting Standards Board and are enforced to ensure all accounting information is presented fairly. For financial statements, fairness means the business's records possess the qualitative characteristics of accounting information. Hence, fairness means all accounting information is reliable, meaning it takes a neutral stance, comparable, meaning it's able to be used to compare to other businesses' records, consistent, meaning it's the same each year for the business, and conservative, meaning information like profits are never overstated. Without this, the information would be pretty useless. So, we can see why regulatory bodies like ASIC take this stuff very seriously. Now, onto the specific types of accounting principles. There are three main accounting principles. The revenue recognition principle, which involves recording revenue when it's earned. The cost principle, which involves recording and maintaining the cost of assets at the historic value. And, of course, the matching principle. For the sake of this talk, we'll only look in more detail at the matching principle. The matching principle can be defined simply as the process of recording expenses in the period in which they are incurred to generate a revenue. The matching principle is one of the most important accounting principles to understand because its influence on the process of financial accounting is so far-reaching. One of the best ways to demonstrate both the matching principle and GAAP is through the accounting for bad debts. Like the cartoon suggests, this is when you deem a receivable to be uncollectible. In a perfect world where GAAP and accounting is not difficult, the direct write-off method will be used hands down. This is because it's recorded in the following easy step: debit bad debt expense and credit accounts receivable. However, because in some cases this doesn't match the period in which the expense was realized and the receivable was created, GAAP prohibits its use. So we got to make like Tinder and get a match. The way this is applied to receivables is called the allowance method, and like the name suggests, requires the creation of an allowance for bad debt accounts. This is an estimation at the end of each accounting period of the number of receivables that will be uncollectible. This is accounted for by creating the allowance account as such. We debit bad debt expense and we credit an allowance account. This opens the account so that if the debt is ultimately written off, we can account for it following the matching principle. Say we've determined that the debt is uncollectible, we can now write it off. Because the expense is already estimated and recorded, the company reduces the allowance for bad debt accounts by debiting it and crediting accounts receivable to completely write off the debt. And like every time I swipe right on Tinder, it's a match. So, to conclude and summarize, because we're able to match a revenue accounts receivable to the same period as the bad debt expense, this method for accounting for receivables follows the generally accepted accounting principles, which is needed to ensure all financial statements are reliable, comparable, consistent, and conservative. Thank you.